MB Mahesh, the analyst at Kotak Institutional Equities, now joins in. Hi, good afternoon. How did you assess the earnings season gone by for the banking space?
Well, if you look at this particular quarter, we were essentially looking at three broad line items. One was on the impairment cycle, how was the formation of fresh slippages as well as fresh restructuring. Second was on the OPEX line, given the fact that this was the quarter where the wage settlement cycle kind of ends. So we need to see how much of pending cost was kind of allocated on the OPEX line. And the third one is how was the performance on the revenue side. I think broadly all three parameters was fairly weak, and one was kind of heading into this quarter for a weak set of numbers. So on the asset quality line, we did see at least the slippages were more or less flat on a QOQ basis, large part of it being explained by the slippage from the restructured book. Restructuring was far probably much higher than what the expectations were. But we would kind of look at this quarter as a one-off, given the fact that this was the last quarter of the sunset clause kind of coming to a close in the current quarter at least. On the OPEX line, the public sector banks reported much higher costs for completing the wage settlement cycle. So that was kind of expected. So a few banks did report a positive surprise on that front. And finally, on the revenue side, you saw that NII was fairly weak, largely following loan growth, and also some fairly high de-recognition of income coming in from the huge restructuring that they did this quarter. And the entire non-interest income line was fully explained by the treasury line. So overall a weak set of numbers, though one should say that there was some level of expectation that this was going to be a subdued quarter.
Okay. Hi Mahesh, thanks for joining in. In specific, what did you make of PNB as well as BOI? What was in common were losses before tax for both these banks? Have you changed your estimates for either or both?
Well, yes. So one did not kind of factor in some kind of a loss in coming through some of these banks. So clearly, if you look at this quarter, these were the two large disappointments which came in from the results side. Factoring the weak performance view, one would kind of expect a cut in the overall estimates, at least for FY16 and to some extent FY17 as well. But given the fact that this number was much higher, broad explanation seems coming back from the same old areas, which is essentially on the loan loss side. One at least when you're looking at your forward numbers, one is not projecting these kind of huge impairments kind of hitting them, at least for the next 2 years. We would probably wait for another couple of quarters to see if this trend kind of continues. Else you could possibly see further cuts in some of these names as well. But for now, we've kind of cut our estimates in these two banks specifically.
Okay. As you pointed out, we were not expecting a great set of earnings this quarter. But what's your outlook going into FY16, particularly on the asset quality? Would it be the same, better or worse in terms of accretion for PSU banks? And how would you compare it, say, to private banks?
The way you look at this entire asset quality cycle is that if you look at the overall stock of fresh slippages, overall stock of gross NPAs and the outstanding stock of restructured loans, one kind of expects this to have probably kind of peaked out. On the other hand, we are still saying that gross NPLs probably will take a little bit more time before it starts to decline out there. The earliest indication that you should see when you're looking at the gross NPA line is the fresh accretion to the overall stock of gross NPAs. If that kind of starts kind of slowing down to some extent in FY16, then you can start building a case that things are improving on the ground. Subsequently, after this, you start seeing whether the recovery and the upgrade cycles are in some of the, at least the larger public sector banks. At this stage, you're not seeing that big recoveries coming through. So you're building a case that the gross NPAs more or less will be flat or probably slightly increased on a YOY basis. And on the other hand, you're building some amount of decline in the overall restructured book. Between public and private, I think the trends are not going to be materially different because even players like in the private sector banks like ICICI and Axis also are kind of running through a little bit of painful time on their asset quality side.
Okay. Now, State Bank of India, has cut rates twice in 2015 itself. So now the management themselves are confident that they would be able to maintain their margins. But would you scale down your estimates on the basis of this for SBI and FY16?
Yeah, broad sense on margins has been on the negative side. The reasoning broadly follows the logic that it's the repricing of the advances which happens faster at this stage. One. Second one is that in times of sluggish growth, there's a lot of pressure for the bankers to kind of cut spreads on their underlying loans. So irrespective of whichever way one looks at the underlying issue, one broadly expects margins to remain under pressure, at least for the entire banking sector. So to that extent, at least the recent cuts taken by SBI is not coming in as too much of a surprise. That's what broadly we build into our estimates at least. But one needs to look at margins in a slightly different way, because you've gone through such a large phase of impaired cycle that the extent of derecognition that you saw on the loan side was reasonably high. So one needs to see if the asset quality kind of improves a bit faster than expected, then the pressure on margins is not as much as what one would have anticipated earlier. So we need to see the interplay between the movement of the asset quality line as well as the pressure which is coming on the incremental loan growth side. That's how you would look at the margin cycle itself for the entire banking space. For the private sector banks, I think the call is broadly clear that margins will kind of head downwards.
All right, and finally, leave us with your top picks in the public as well as in the private sector banks.
In the entire space, we like, amongst the private sector banks, we like ICICI and Axis Bank in the frontline names. We like Federal Bank in the mid-tier ones and DCB in the smaller cap names. And in the public sector banks, we continue to maintain our weight on overweight stance on State Bank of India. That would be the broad pecking order in both the private and the public sector bank space.
Right, Mahesh, thanks very much for joining in with your quick take on the Q4.